Hey there, welcome to the part 4 of our online session. In this video, we are going to understand two things. Number one is Fibonacci retracement and extensions, and the second thing was volume profile. But I was confused between volume profile and volume rejection. What should I teach you? Because volume profile is a thing which is used by institutional players on higher level prop desk things and everything. And volume rejection is a thing which you can actually use in your day-to-day intraday trades. So I was confused between these two, so I finally chose to go with volume rejection rather than volume profile, because even if I teach you what volume profile is, you won't really be able to use it that way to its full potential, because as a retailer it is very difficult to use volume profile in your trading. Rather than that, we are learning volume rejection now. So volume rejection is a concept where I'll explain everything in detail later, but it is basically the rejection of volumes that helps us in taking the trade. It basically adds additional context to our trade. So first start off by understanding what exactly is Fibonacci. So Fibonacci was an Italian mathematician who developed his Fibonacci calculation thing in 1200 AD, which is like 900, almost 800 years in the past, and it is still used even today. And he developed a kind of sequence of his own, and the sequence was like the next number is going to be the sum of the previous two numbers. So you do not need to really understand this, but I'm just telling you as a fact. So according to Fibonacci series, the next upcoming number is going to be the sum of previous two numbers. So let's start off by understanding it this way. So 0, 1. So the next upcoming number is going to be the sum of these numbers, which is going to be 1. The upcoming number is going to be the sum of previous two numbers, which is like 1 and 1. So it's going to be 2. The upcoming number is going to be the sum of these two numbers, which is 1 and 2, which is 3. Then the upcoming number is going to be the sum of these two numbers, which is 2 and 3, which is 5, and so on and so forth. Now, the Fibonacci thing, the Fibonacci guy said that this particular sequence is observed literally everywhere in nature. It is there in flowers, it is there in fruits, that particular sequence. Like how many fingers does a human have? 5, so that is a Fibonacci number, and all those things. So traders came in from other side and said that if this Fibonacci thing works everywhere, why not it will work in trading? So that is how the Fibonacci in trading was developed. That is how it was derived from. So what exactly is Fibonacci we'll understand on charts. But before understanding Fibonacci, let me give you an example of what retracement means. What is retracement? Okay, so markets, you must have observed, markets never go in a straight line. They never go up in a straight line. They never come down in a straight line. So how do markets behave? If you have observed, then markets go, if they want to go up, they will go up, then they will come down, then they will go up, then they will again come down, then they will go up and come down, and similar pattern is being repeated. All right. So this pattern, let me show you an example right away. Okay, this is the Tata Steel chart. So see how it went: up, down, up, down, up, down, up, down. So a big up move followed by a small down move, a big up move followed by a small down move. And this small down move is what we call a retracement. Okay, this small down move is what we call a retracement. So markets never go in a straight line. Even when they are falling, they will fall, then they will go up, they will fall, then they will go up, then they fall, then they go up, and then they fall. So why does this pattern happens in the first place? Why do they go like this? Why? So what happens is, let's say this someone has bought markets over here, this level, okay, and he's he's satisfied with the profits now, and so he thinks, okay, let me book my profits. So other people along with him who got over here see some signs of rejections, and then they start booking as well. So this part is basically the profit booking part. Now this part actually serves two purposes. First is profit booking, and the second thing, which is very interesting, is to trap late entry people. So any chart, it will not go up straight line. That it is the major reason, because people who bought over here are going to book profits at some point of time, and these people who are buying markets before even they start moving are usually the FII or the DII people, meaning the institutional guys. So they are basically moving the market. And when they book their profits, they have the ability to move the markets again on the lower side. Because they book their profits, their quantities are not 100, 200 or 1 lakh, 2 lakh. They deal in huge quantities, maybe 5 crore, 10 crore quantities and something of that sort. But basically their quantities are very large. And when such quantities are punched into the market or flushed into the market or taken out of the market, market moves, market reacts to it. So when they push heavy quantities, like let's say this stock was consolidating for a long time and then all of a sudden a DII appears and starts to buy over here with huge quantities. What happens? Then market reacts to that quantity and starts to push up. And then along the way, as market starts to go up, this becomes a consolidation breakout. And looking at this, many other people enter as well. And that keeps the price driving higher and higher. Now let's say the institutional guy is done with his uh, trade or whatever his swing trade or investment was. He is satisfied with his profits. Let's say he booked a 15% profit over here. He's getting good profits, and now he wants to book. So he books his profits, and because of his quantities that drove the market up in the first place, the quantities their quantities are huge. So similar quantities are getting booked right now. So that is why the market starts to come down. But as soon as their quantities are done, what happens is market stabilizes again and starts to go up again, because the market keeps coming down only until only when they're selling. So once they stop selling their quantities, I mean once they stop exiting their profits, market stabilizes again and starts to go in the original direction of the trend. Now what is the trend over here? This is the trend. This is the positive trend. But it also acts as a trap for late entry people. Like let's say someone who entered over here, just by seeing this, he could not trace this stock earlier or asset earlier or here, and then he later figured it out that this might keep going up. So what happens is he enters over here, and then these profit booking people, institutional people, book profits. Stock comes to starts to go down, and he exits. He says, "Oh no, this is not going my way. Let me take an exit," or their stop loss ends. So something like, let's say someone is entering over here and then the market dips heavily. Now, if someone is entering over here, where will the stop loss be? Somewhere over here or here. So the market makes sure the stop losses are out and then it goes back up again. So this process keeps on repeating. So it is not only a profit booking move, but it is also to basically trap those late entry people who are entering here and here. So that serves the purpose. And then when these late entry people start seeing the market go up again, they are like, oh, I knew this was going to happen, but I could not make profits out of it. This is because they enter at a wrong time. So what is the best entry point? When you see something going up, don't have that FOMO, FOMO, that fear of missing out. Don't have that FOMO with you. What you can do is basically wait for the retracement. And once the stock is retraced, once the asset is retraced to a particular support zone, you can enter over here. Now the question is, okay, how are we going to figure out where the support is? How are we going to know until when or where the markets are going to retrace? Like they can retrace until this point also, na? Who is to know? How are we supposed to know? So that is exactly why Fibonacci retracement and extensions are used, because Fibonacci gives you an exact idea of until what level market can go down or go up according to the trend. So when a market is coming, when the market is going up, we see for support levels, and when the market is coming down, what we see is until when or where the market will resist again, so we can sell there and the markets will head back down again. Okay, so this is why Fibonacci is used. So let's understand on charts now. I hope you have gotten the idea of what retracement means. So, uh, okay, this is a Tata Steel chart. I like this chart because this was such a great chart since last 1 year. It was at 250 levels and now it is trading at 1450, 1500 levels. And it is a super steel cycle that we are in right now. So to understand Tata Steel, let's go back a little bit in the past. So here it was, just getting banged from 2 years, 3 years. It was just not being profitable. I mean, the company was profitable, but the stock was still getting banged. It was just coming down, down, down without any real reason. But then here we got a good up move. Uh, so now what we can do over here is we can use Fibonacci. Now where you can find Fibonacci is you can go to this pencil thing if you are using kite and then go on Fibonacci and then this is the Fibonacci retracement. So this we have to use. Now how Fibonacci works is for you to apply Fibonacci on a chart, you need to have a swing high and a swing low. Okay, so swing high, and a swing low. So what is a swing high? Swing high is basically a point from in the recent point we can say from where the markets have pushed to the highest possible point, and swing low is the point uh, in the recent past where the markets have showed their lowest point. So in this particular chart, I can say that this is a swing high because in 2020 this particular point was a swing high because market could not go above this particular point. So this was a high. This was not an all-time high. This was not a 52-week high. This was a swing high, meaning uh, a high in, let's say, 2 or 3 months in that particular time in what you are seeing the markets. So this was a swing high. Even this can be called a swing high for that matter. But because the market was falling, and why am I choosing this in particular? Let me tell you that also, that why am I choosing this point as particular because um, just a second. If you see over here, this level was acting as a resistance. So the slanting resistance was there, and that got broke in this particular month. December and January, start of January and end of December, the markets broke this resistance. So that is why this becomes an important level, and that is why I am choosing this as a swing high because it gave a breakout above these levels. But soon after that, it came back down again, and that is where we have to understand that after giving a breakout, if it is falling, then either it is uh, going to go even beyond the lowest point or it is going to shoot up higher by trapping all these people. So there are two possibilities and we won't know what is going to happen until and unless we wait and watch. So this was the time of wait and watch, and once we got a swing low, this was the swing high, this was the swing low, and market started to go back up again. This is where we can use our Fibonacci. So if you see clearly, the markets came down. Now this is where we have to do a bit of micro analysis. So markets came down after breaking out of the market of the resistance, came down, went up again, and then started to come down again. So this week, if you this is a daily chart, so this one candle is going to be of 1 day. So this week right here is important because if this week continues to come down again, then all this is useless. So where this particular week was going to stop, where this particular selling was going to stop, was important because so the people who bought over here would sell somewhere. The people who bought at 270 levels would book their profit at 350 or so levels, right? So until what point is the market going to fall, we won't know. But that is where the Fibonacci comes in. So we are going to choose highs and lows according to the direction of the market. So because market came from up to down, we are going to apply Fibonacci from up to down. When the markets go down to up, we apply Fibonacci from down to up. So for now it came up to down, so we choose click on the swing high, then we get this. Okay, let me just choose a smaller line. a thinner line. Okay, so here we have our swing high. So we click on swing high and then we get these sort of patterns. So then we click on swing low. Then we click on swing low. So now we have our swing high, we have our swing low. Now if we see on a micro level, see this is exactly why the selling started over here. Oh, sorry. Let me reassign it again. I moved it by mistake. So this was swing high, this was swing low. And after you place Fibonacci on the chart, you get these multiple levels. What are those levels? Let's see these levels first. 0%, 38.2%, 50%, 61.8%, 100%, and these are extensions. So these levels between 0 to 100 are retracements and these are extensions. So we have minus 38.2 and minus 61.8 over here and 138 and 161.8 over here. So the major levels for Fibonacci are these three: 38.2, 50 and 61.8. These are the main retracement levels. So as you can see, after breaking out, it came down, it made a low, and then you have to look now at exactly where these people, institutional people I am talking about, booked their profits. This is not a, a random place or random level that the markets have turned from that level to this side. There was a reason these people started to book profits over here. What was the reason? The reason was this. See, 38.2% exact. The high of that particular week is exactly 38.2%. Unbelievable, right? Now, this is again, when you're using this on a standalone basis, it becomes difficult to judge anything. So you have to get the context of other things as well. So now if you can see here, let me mark this. There was this resistance from the previous times, which was acting as a support. So once we have understood in the last session that once a support breaks down, it becomes a resistance. And once the resistance breaks down, it becomes a support. So now you have to understand that there were two levels where potential profit booking could have come. One was 322 and the other was 38.2%, that is 350. So this again starts to act as a supply zone. So the people who bought over here would start booking their profits from this level and keep booking until these levels. So this is how you get and gather context of multiple things. And then it went to 38.2 and started coming down again. So now we do not know where this move will stop. But if it goes below 0%, then this pattern is invalid. This up move that we are looking for is invalid. But it did not, it went up again. And as soon as it breaks this 38.2% level, you know what the next target is? The next target is 50%. And then the next target is 61.8%. Again, let's go on a micro scale to understand what happened. Once it broke 38.2, it went to 50% only to get rejected. Before blasting out of 50%, it got rejected. What does that mean? It means that the people who entered over here, again, this candle, you see this green candle is formed by institutions. This is not formed by retailers. Institutions book profits over here, ride this trend until here, then they book profits over here, trap some retailers, market comes down, again enter over here, and then they take the markets up again, exit over here, then get rejected, then again they break out of this particular thing. So this is how these people operate. This is how these people operate. So after 61.8, this particular chart of Fibonacci does not, in this particular user interface of Zerodha, it does not show another level that is 76% or something. That level is there. So that level comes out to be somewhere over here. So that is why there was this kind of rejection. And then if you see where it took support, it is easier to I know it is easy to just point away after the things have happened, but I cannot really explain you these things in live market because Fibonacci thing uh, is better off for swing trading rather than intraday. It is not like that it does not work in intraday, but it is advisable for you guys to use it in swing trading or investment or making while making investment decisions. So it becomes easier because in intraday it is too much of noise. Fibonacci can get confusing at times. So for swing trading, even if I use live markets, it is going to take few months to actually show what has happened. So that is why uh, I can understand you might feel that hey, ये तो हो चुका है, this has happened, anyone can show. But yeah, I know, but this is how stuff works. This is how Fibonacci works, and in live market, I really cannot show you Fibonacci because even if I take any swing trade, it is going to take 2 or 3 months to complete whether the particular target is there or stop loss is there. So what you can do is you can just understand the concept clearly and then start using it on your live trades on swing trades or whatever that you're doing. This is you can use for intraday, but I won't really recommend you to use this for intraday because it will get confusing after one point. So this is just a idea for swing trading or positional trading. And I'm going to tell you the downsides of Fibonacci as well. So I'm not just going to show you that, hey, look over here, it took support and just blasted, it took resistance and came down. Not going to do like other trainers. I know this sucks, but that is why I'm going to tell you its downsides as well. So you understand completely the concept of Fibonacci and then work according to that. So then we have this swing high, swing low, then this rejection, and then went up. And now again you have to see until when this market corrected. This came exactly until 38.2%. So this works like magic. This works really works like magic. You can see it on screen. The only thing is you have to keep your confidence and trust in the system. Just because you are seeing some fluctuations, you should not panic. That is the number one thing. And after it took that support on 38.2, now why would it take support at 31.2? Again, not just because Fibonacci, you have to gather multiple context. What are those multiple contexts? Because first, the first time it took resistance over here, it also becomes a support level now. So there was this support level plus a Fibonacci level, which combines to make a great technical level. And that is why it took support over there, went up, and did not give any, just blasted out above 6100 and all those things. And then see, 161.8 is usually the target levels when it shows a retracement and retraces back above 61.8. So in such cases, when stock is in a good momentum move, it usually goes and completes the retracement, the extension targets. So what is the extension target? They are 138.2 and 161.8. And for a downward coming stock, the targets are minus 38.2 and minus 61.8. So after that, it made multiple new highs and new lows. So you have to keep reassessing those highs and lows because you just cannot use one swing high and swing low and keep analyzing that stock for whole year because the stock keeps making new highs and new lows, and according to that, you have to take your steps. So let's see. Let's draw another Fibonacci thing on this chart to see how it performed. So this, after making this was the new swing high, a low, and then this was the new swing high. You can agree, right? This was the swing low, this was the swing high, because after this it did not went down, and after this it did not went up for some time. It retraced back almost for a month or so. So this was our new swing low, this was new swing high. And what do we get from this? When we get new swing lows and swing highs, what do we get? We get to understand the kind of retracement that is going to come. So it, after plotting this, we had 38.2 over here. So it was kind of a support zone for the markets to start going off from there. But again, you just cannot use it standalone. You have to gather multiple contexts. So there was this 600 level which uh, acted as support for the markets. Now, why 600? Now, if you can see, It never came down to 38.2%. It actually just went up from this level only. In fact, there was a support at 38.2 also. The price action support of this previous thing was at 38.2, but it never came to 38.2. This usually happens because of two things. One, that it took psychological resistance at a level of 600. So what is psychological resistance? Let's say when you buy something at 999, your mind says, oh, this is only 900 rupees. But in fact, you're paying 1000 rupees. Or when you're buying something at 499, your mind says, oh, this is 490. Okay, that is good. But you do not realize that you are end up paying 500 rupees. So that is exactly how psychology works. So this is exactly same in stocks as well. So when it came down to 600, so these round of numbers often uh, start to act as psychological supports or resistance. So it went up from 600, and the second reason in such cases can be the huge momentum. So as we can see, the momentum was in its favor. Uh, Also, the psychological support was there. It did not care to touch that exact 38.2, but it came very close to uh, retracing until 38.2. And then the targets are what? Then the targets are 138.2 and 161.8. So when do we have such targets? So after it retraces back and breaks above this 0% again. Once it breaks above this 0%, we can keep our stop loss below this low and then have targets of 138 and 161. So here the new targets were achieved, and then new highs were made, new swing lows were made, and then it just blasted one-sided. So this was again the new high, and this was new low. So understanding this again. Hmm. So after this, actually, it went in a clumsy mode. There was a sideways kind of moment in this way. So that is why even now it is kind of in a sideways moment. So there's nothing much to analyze in such cases, because when you see the market is trending like that, that is where the move actually happens. But when you see the candles are not moving anywhere. They are forming, but they are forming in a range. So this is a range bound consolidation. So until and unless it breaks out of consolidation, it is difficult to analyze anything. But I hope you're getting the concept of how Fibonacci works. So Fibonacci again, this is Nifty 50 chart, and you all remember the Nifty 50 fall of Corona. So let us go there and see what happened. So we had this as swing high and this as swing low. It all happened very fast. That Okay, so in Fibonacci, 61.8% is considered to be the most important level for any particular asset or whatever that you are analyzing. So whenever a stock or any asset crosses above or below 61.8% according to the trend changes, which means if we can see here, the momentum was completely negative. It made swing high, swing low, and then once it goes above 61.8% again, it is said that the trend has been changed, which means the negative momentum is no longer there. Until and unless it is below 61.8%, it is still counted as a negative retracement, which means this, let's say, Nifty came like this, so went up. Until and unless it's below 61, it can still just touch 61 and come down again. So until and unless it's below 61, we still count it as a negative retracement. But once it crosses above 61.8%, it is considered that the trend has changed. So now here the trend was negative, and then it went up to touch the 50% mark, then retraced back, then went up again, and then it took a hit at 61. Took resistance at exact 61%, came down again, then went up, and then it started to close above 61.8% on a sustainable basis, like this candle or this candle. It sustained above 61.8. After gapping up on 61.8, it retraced back, tested it again, retested this level, and then started its way back up again. So in such cases, when it breaks up above 61.8, as we discussed earlier, the target levels for Nifty become 138.2 levels and 161 levels. So now get ready to get surprised, because as soon as it came to 161 level, here the retracement came. All the institutions who were long from the Fibonacci analysis or whatever started to book their profits as soon as the markets hit 61.8%. 161.8. Isn't it magic? This is how it works. It is really a magic. Okay, so it went up until 161.8, completed the target, retraced back until what? Until 138.2. So see, it's all Fibonacci, it's everywhere. And then it broke above this high, only to again take support at that very level. See, it took the support twice, one, two, three, thrice. It took the support on 161.8 thrice and then blasted up again. So this is how Fibonacci works. Now let me tell you the downsides of it as well. The biggest downside is it only works in trending stocks or trending assets. It does not work in sideways markets. So you have to understand the what is sideways market. So let me tell you, let me give you a graphical example. This is sideways market. Whenever any asset goes side range or range bound or keeps oscillating between a particular range, then that is where you cannot use Fibonacci, because if you use Fibonacci in these levels, it is going to take your stop loss multiple times. It is going to give you multiple losses. So this is what the biggest downside of Fibonacci is. It operates wonderfully when it is applied on a trending chart, but whenever the chart is not trending, whenever the chart is like this, see, this is again sideways zone. So you cannot consider this part, and it becomes very difficult to analyze whether this particular thing is a sideways or trending in live markets. Like, just imagine if this chart has not happened and we are somewhere over here. So now it would become difficult to explain that whether whatever that's going on is a sideways market or a trending market, because some people would argue that, hey, it is going to break out above this. Some people would say, hey, no, it is going to break down below this. Some people would say, hey, no, this is just going to go sideways. So it is really difficult to analyze a particular asset whenever it's live, uh, to understand whether it is in a sideways range or trending range. And once it is in a sideways range, it usually takes some time to display to us that yes, it is in a sideways range. So it will take some time for you to understand whether the market is in a sideways range or in a trending mode. To be honest, when it's trending, it is easy to plot all this, because when it's trending, it usually does not spend more than a week at any given point. Like, as you can see, it's hardly spends any more than 5 to 6 days anyway. So it keeps rising, or any chart that is in a negative or downtrending side, let's say Vodafone Idea, like it went down heavily. So charts like those, they keep they just do not stop at one particular point, and that is the only way you can understand whether the current market is in a trending way or in a sideways range. So here, so whenever a market falls or rises, it usually makes its intention clear that it is going to fall or rise, or basically it's going to stay trending. See, it hardly spent any time, or it hardly wasted any time at any particular level. It just kept coming down. And then when it came down, you can see, let me chart a rectangle over here. Then when it came down, this was a consolidation zone. This was the zone where it stopped moving either up or down. So this is a sideways zone, but it takes time for you to know that yes, this is a sideways zone. Again, we are currently in a complete sideways zone. So many people are long on Idea and Vodafone. I don't know why, hoping a turnaround story, but the company is loss making. So I don't know why they are just holding on to those losing trades. But anyway, here, this is how the sideways market looks like. Uh, to be honest, it is again a breakdown. So here, this was the support of that consolidation range, and then it broke down below this just a few weeks ago, and then bang bang. So this is what happens when usually it's a stock that has been consolidating for a while comes out of consolidation. But since this was already at 5 and 6 rupees and 7 rupees, there was not much of scope to fall, and that is why you did not see much of fall. But in terms of percentage, it is a great fall, like from 8.5 to 4.5. This is like a 50% drop in terms of percentage. So don't go on digits key from 8 it has come only to 4, but if you see the percentage terms, it is same like a stock coming from 1000 to 500 or 10,000 to 5,000. So the drop is in terms of percentage, it's great, it's huge drop. So I hope you have understood Fibonacci retracements and extensions. This is how you use. You have to have a swing low, a swing high. Okay, a swing low you need, a swing high you need, and then have to chart a plot. Then have to plot the chart, sorry, according to how the market have behaved. Like if the market is coming down and this is the swing high, then you have to plot that way only. If the market is coming down, then plot this way, downwards. If the market is going up, then plot thatwards. That is how you plot Fibonacci. And then you have those levels 38.2, 50%, 61.8, and then the extensions are there. And then you can uh, make your entry or exits depending on the Fibonacci levels. Now we are going to understand another concept, that is volume rejection. Now, what is volume rejection? Let's understand volume rejection. So, volume rejection is a concept that works best in indices, which is Nifty and Bank Nifty. All right. So let's understand volume rejection. Let it load. Okay. Today was a very choppy day. It was just sideways all around, and such days are very difficult to trade. But in such days also, volume rejection works just absolutely fine. So let me remove all these indicators and stuff. It will just add up to the confusion. All we need is volume. So volume is the only indicator that we are looking for in this particular thing. So what does volume rejection say is basically even this is something which you cannot use on a standalone basis. See, technical analysis is uh, all around the same. You cannot use anything on a standalone basis. You have to gather multiple context to understand what's going on. You have to gather multiple context to get a better idea of what is going on in the charts. So volume rejection, what exactly is volume rejection? For volume rejection, you have to see a candle that is with volumes. Now, how do you find a candle? And because in the first 30 minutes and last 30 minutes of market, there is huge volume by FII, we are going to ignore these first 30 minutes and then the last 30 minutes of the markets, like last 15 minutes or so, because the volume is generated because of the BTST and STBT trades. That volume does not really count. I mean, it does count, of course, but it does not help us. So then we are left in the mid session. So what you have to do is you have to find a candle that is kind of a huge candle and is with huge volumes. All right. So for here the volume is just dry. There's no volume. There's no volume. There is no volume. Where is the volume? Here is the volume. This candle. This is the candle which has the highest volume for the day. It is not necessary you should find the highest volume candle, but you need a good volume. And then what you have to do is you have to wait. You have to wait. Now this works extremely well when you work with the trend. Now, what is the trend of Nifty? Nifty has come from levels of 7,500 to levels of 17,200 in a span of less than 18 months. So this means the trend is supremely positive. It is just a mad bull run going on. And in a bull run, in such a bull run, when you get such candles, they are usually for trapping people. All right, they are usually to trap the people. So now let's see what happens over here. So the market was going up. There was okay volume, but then there was this huge sell-off, insane sell-off, volume sell-off that came along. Now what we have to look out is which candle has the highest volume, and it needs to be a proper candle. It does not needs to have huge wicks and shadows like this one. So if this candle would have been like this, we would have ignored it. We need a proper candle with a good body. So this is a good body candle. It has the highest volume. Then we have to mark the highest point of this particular candle. All right. Now we have to wait. All we have to do is wait. And then the thing is, what is the technique? Whenever the market is trending in one particular side, like we have a current bull market right now, market will usually trap people with these candles and then retrace back again above these levels. So these people are trapped, but market keeps on moving higher. All right. So in such cases, how should you trade? What exactly is the pattern we are looking for? So this is the volume candle. We have marked the high of this volume candle. The thing is, whenever market now goes above the high of this volume candle, you have to be extremely bullish about the market. In intraday, I'm talking, this is intraday. Okay. Whenever the high of the volume candle is taken out, you have to be insanely bullish in this particular example for the remainder of the day. So as you can see, this high of this candle also acts as a resistance, and that is why that needs to be taken out. You cannot go long before it is taken out, because if you can see over here, the market got rejected exactly from the high of this particular level and got rejected. This was a stop loss hunting, of course, but see, the rejection came off the same level. So you have to wait. The trend is positive. Okay. There was this hunting, huge hunting, and then you have to wait until the high of this point is taken out. The high of this candle is taken out. It was taken out at this level. This candle not only took out the high, but also gave a sustainable close above this high. This is exactly where you buy. This is exactly where you buy. Where would be the stop loss would be? The stop loss usually can be the midpoint of this candle. The midpoint of this candle. Why? Because if the sellers are again trying to push below the midpoint of this candle after taking this high, then that means seller really have the power right now. That usually does not happen, but when it happens, you have to get out. You do not have to struggle against the market. Okay. So here you can buy, and then the markets went up. But the funny part was in the last session we understood RSI. Now again, as I said, we have to gather multiple context and keep adding those context to the chart. In the RSI session, for those who skipped the indicators part, let me briefly tell you what the RSI was. RSI people keep the setting as 80 and 20 and say that whenever it is above 80, we have to sell. Whenever it is below 20, we have to buy. Basically the overbought or oversold zones. We do not have to act like that. We have to act exactly opposite of it. We have to change the settings from 80 to 70 and 20 to 30. And we are not going to call this as overbought or oversold zones. We are rather going to call these zones as buying zones or selling zones. All right. We are going to call these zones as buying zones or selling zones, which means whenever the RSI is above 70, we are going to go bullish. instead of getting bearish. Now, as I previously mentioned in last video, that this is a controversial statement to be against of how bookish RSI works, but this is practical. This is, I do not want to teach you guys theory that does not work. I want to teach you practical knowledge that has come from experience. So whenever the RSI is above 70, the actual move starts from there. The actual momentum starts to begin there. Now you have to gather the context that, okay, there was this volume rejection, the market broke about over here, and as you can see, the RSI was this peak. I don't know if you are visible. This peak is visible. Let me just increase the width of this. This peak was at 70, 69, 70 levels. Okay. So the peak, you have to understand that the peak of this volume candle has got out. Buyers are in and RSI is now near 70 zones. What does that mean? Think about it. What do you think you should do? Keep watching markets? No, no, you should buy. You are having multiple contexts to go long on this chart. First and foremost being the trend itself. The trend is supremely positive, then you get this hunting, then the hunting is taken out, and then the RSI is now heading towards 70 zones. For normal retailers, for normal people, for people teaching on YouTube, 70 is the zone from where you should start selling. I say just check it, just do exactly opposite of it. Start buying, because that is where the exact momentum is there. That is where the exact momentum is starting. So now if you saw this was 230, you buy over here, keep the stop loss over here, somewhere over here, fine. What happens next? Momentum comes in. And when momentum comes in, it comes in huge. Now you might say this is a small move. Let me tell you, this is 17070, and this level, or the, I won't consider the highest point. Let's say this level is 137, 140. So it literally gave a 70-point up move in such a short amount of time. What was our stop loss? What was our stop loss? It was hardly 25 points. We entered at 70 levels. Stop loss was hardly 17,045, which was hardly 25 points. For the risk of 25 points, we got in 70 to 75 points, which is 3x of what we normally risked. So this is how you have to understand volume rejection and use other technical analysis to gather multiple context of what is happening in there. All right. This works in uh, charts as well, the stocks as well, but it is usually the best thing in indices. So again, yes, here's the UBL chart. So the trend has been positive clearly. So once you know what the trend is now, it becomes easier to take trades on a daily basis. So only what we need is only the volume. Okay. Okay. So here there was no volume, although the candles were big, there was no volume. Now this is UBL, and this example I'm choosing to tell you that what should not be done. Like what should be done, you know that, but what should not be done is even more important. Now when you see here, UBL gave this insanely huge moment. Went from 1490 to 1520 in 9 minutes. This is a 3-minute candle. And after that, the rejection came. Now you will say this was the highest candle. So should we short below the low of this candle? No. No. Why? Because the trend is positive and this is not short selling. This is profit booking. So you have to understand the difference between what is short selling or and what is profit booking, or what is short covering and what is long build up, which means fresh buying. Whenever people buy fresh or whenever there's a short covering, there's same kind of momentum and volume. So you have to you get confused at times. You have to understand that by experience. I cannot teach you that, but because the trend is positive over here, just because the this volume candle was taken out by the next candle, you should not sell. What you should instead do is look for the most volume candle on the red side, which was this. Okay, this had even more volume. So mark the high of that candle. Here we are not looking at the size of the candle, but the volume size of the candle. Whichever candle has most volume is the candle we are looking for, not the size of the candle. Okay, whenever, whenever, now in this case, whenever the high of this candle is taken out, you go long. That is what we discussed, right? The high was taken out exactly the next moment. Where would you keep stop loss? You would keep stop loss over here. And then there was stop loss hunting. See these wicks? There was not one close below this, but it was a stop loss hunting because operators know that people have stop losses over here. So they make the markets drive down, take your stop loss, you are out, and then what happens? Then this happens. So you have to be very careful while trading to not give in your stop losses to the operators. And the thing how you do is by keeping the stop loss mental and not in the system. But you need to have the discipline to get out when you know you are wrong or when your trade is invalid. We'll discuss stop loss hunting later on, but this is how volume rejection works. Isn't it amazing? The momentum buildup is there, and once it is done, like here again, the candle was there, and once the high of that candle was taken out, see the volume candle, we got insane huge momentum. I hope you're getting the point. Let's now see if we are getting anything on the downside. So to find a trade on the downside, we need to have a stock or an asset that is in a downtrend. What is this? Oh, there's no liquidity in Vodafone Idea. There's no point looking at this chart. Okay, no worries. But let me tell you the concept. Okay, so the buying concept is that whenever you buy or based on a volume rejection thing, you have to buy when the trend is positive and when the high of such candles, huge volume candles, is taken out. That is when you have to buy. All right, so let's go to Word. Let me just type in there so it becomes easy for you to understand. All right, so what is the funda of volume rejection? Let me increase the font size. Okay, so volume rejection. The condition for buy is trend must be positive. The first condition for buy is trend must be positive. Then there must be a huge volume selling candle, which usually means that people's stop losses are getting hunt or institutions are booking profit. So first thing is trend must be positive. Second thing is there must be huge volume selling candle. And third, the entry point is you go long when the high of that red volume candle is taken out. So this is the condition for buy. It works for both sides. I will tell you the condition of sell as well. For the buying side, trend must be positive. Now let's look at the example that we just saw over here. What was it? It was Nifty. Okay, so this was the thing we saw over here. So the trend is positive. Yes. Is the trend positive? Yes. Then there must be a huge volume selling candle. Is there a huge volume selling candle? Yes. And then you go long when the high of that red volume candle is taken out. So is the high of this candle taken out here? Yes. So all the conditions are satisfying. And even after that, you have to take the help of few other indicators or price actions to get more confidence. Once you get confidence and once you start trading this for more than, once you have traded this for more than 100, 200 times, then you can just enter based on standalone volume rejection. But until then, to gain confidence, use RSI or moving average. All right. I have explained how to use RSI and moving average in the last session. So if you haven't watched that, please go and watch that first. So there must be huge volume candle, and then when the high is taken out, we go long. This is for buying side. Now exactly opposite of it is the condition for sell side. What is the condition? Tell me, what should be the trend when we are selling? Should trend be the positive trend or negative trend? Yes, trend must be negative. Then exactly opposite of this is going to be on the sell side. So trend must be negative. There must be a huge volume buying candle. Now this is exactly opposite, right? So the trend is negative, which means something like this. The trend is negative, and then a huge volume buying candle is coming up. And then when the low of this candle is taken out, you sell. You sell the markets. Okay. So when the last change over here is you go short, not long now. Now you have to go short, meaning you have to short the markets first and cover them later in profits. So you go short when the low of that green volume candle is taken out. So the conditions are exactly opposite for buy and sell. So we do not have any examples as of now because the kind of momentum we are in, there's hardly anything to explain whether this is going down or not. But let's see if we find anything. Let's see in today's market was pretty much the sideways, but yes, so there was no volume. The volume were dry, and this was the only candle which had volume, which low got taken out at 318, which is useless. So we are not going to trade this in first 15-20 and last 15-20 minutes anyways, because the BTST and STBT volume is there. So it is not going to help. But let's see if we are able to find something on previous charts. This is September and the September has just begun. So it is really difficult to find volumes on days of August. Anyway, no worries. Here we have it. Here again we have a buying side. So this was Nifty. This was this volume, huge volume candle. In fact, it was not the huge candle we are talking about. This was the candle we were talking about. So again, first, you do not have time in live market. So you have to assess the conditions for going long. What are the conditions? The trend needs to be positive. Is the trend positive? Yes. Then there needs to be a huge volume selling. Is there a huge volume selling? Yes. Which is the highest volume selling candle? Over here. Yes. Mark the high of that particular candle. Okay, yes, done. And whenever the high of that candle is taken out, what you do? You go long. So the high is taken out over here. Where is your stop loss? Over here. Now this is the thing I was talking about. The stop loss hunting thing is everywhere. So you need to be very careful about that stop loss hunting. Now let's understand stop loss hunting in basics. What exactly is stop loss hunting? So stop loss hunting is going to be everywhere, no matter what you trade. If you trade Forex, commodities, Bitcoin, crypto, whatever you trade, the stop loss hunting is going to be there and you have to take care of that. All right. So the stop loss got hunted of the people who went long here and then the market shot up. So how do you deal with stop loss hunting in the first place? See, you have to know that along with you, many people are entering at this particular position, right? So you have to expect a stop loss hunting pre-hand. So you have to expect a stop loss hunting. You have to expect that stop losses are going to get hunt. What can we do about stop loss hunting? So usually how stop loss hunting operates is it is very fast and furious, meaning the stop loss hunting, if the stop loss hunting is to be done, it won't like it won't spend a time at a particular time on a particular price. It will be very fast and furious, just upside, just a wick. It will just create a wick like we see over here. It is going to be very fast and furious, like it will just come down, take these stop losses and go back up again. So if your stop loss is like over here and the markets you bought over somewhere over here, and then they are coming down, and then they went down furiously, you do not have to panic. First thing is, you do not have to keep your stop loss in the system, because that is very obvious. They are going to get out, they are going to be taken out, because all the data that we put in the system is sold by brokers to these institutional people. So these institutions all know where the stop losses are. That is a brutal thing that happens in markets, and there's nothing we can do about it. So what we can do, we can just understand what is going to happen and then act accordingly. So let's say you bought over here, and then you keep stop loss over here, and then the market drove down and went down. Now this is the point where you panic, because your stop losses are hit. This is the point where you panic, and this is exactly what the professionals want, what the institutions want. What you have to do instead is keep a buffer stop loss. Now this is what I call a strategy to exit, to get to avoid stop loss hunting. What is a buffer stop loss? Buffer stop loss is a stop loss where, let me explain just a second. Buffer stop loss is a point which is not really your original stop loss. It is far away from your original stop loss, which might be more than double of your original stop loss, but that is the last point until when you can hold your position. Okay, so buffer stop loss is a stop loss to the stop loss. Buffer stop loss is basically a stop loss to a stop loss, because nowadays stop loss are getting hunted every single second. So you have to keep a buffer stop loss, which means you don't have to keep stop loss over here, but rather you have to keep your stop loss over here in this particular example. Like the meaning or the concept is, if the market really wants to go down, let it take my stop loss. If it really wants to go down from here, then let it take my stop loss. I'm happy to give it. But if it is not going to go down, then why the hell should I give in my stop loss? Isn't it legit? Isn't it valid? Like, ask this question to yourself. Rather than losing on random trades, keep buffer stop losses, so that whenever you get a good momentum trade, a great trade, you can risk more than your usual to gain more than your usual. So this is a buffer stop loss. So what would your normal stop loss be? Your normal stop loss be over here. Keep your buffer stop loss over here, meaning don't put a physical stop loss in the system at this level. Put a physical stop loss in the system at this level, and keep a mental stop loss at this level, meaning if the market started to sustain over here, then you have to exit and cancel out this order. But if the market is not sustaining and just making a spike, this is what we call a spike, then you can be sure that that was a stop loss hunting. So start to keep a buffer stop loss. Buffer stop loss is very important, because until and unless you have a buffer stop loss, your every stop loss is going to get hunted. Like the stop loss in here, UBL. We saw this example, right? We go long after this high is taken out. We keep our stop loss over here as per the analysis, but that is taken out. See, and then it went up. So what would have happened if you had kept the stop loss over here? Okay, when you lose, you're going to lose 2x of what you normally would lose, but that would still be fine, because most of the time, 90% of the time, when it is taking your stop loss in such scenarios, it is just a stop loss hunting, nothing else. And see, so the buffer stop loss would have saved you in this case. So start using buffer stop losses. So stop loss hunting is a thing which you cannot really avoid, because our data is being sold by brokers to all these institutions. So we cannot really do anything about it, but we can control ourselves. We can control our trades. Maybe take less quantities over here, because you know your stop loss is going to be big, so you can manage your risk accordingly. But that is how we can save ourselves, by using a buffer stop loss. So I hope you understood Fibonacci. I hope you understood volume rejection, and I hope you understood what stop loss hunting is, and how to save yourself from stop loss as well. In fact, I have made a specific YouTube video on stop loss hunting. I'll link that to description. So head over that and watch that video as well. That is also a good video. You will get to learn to know a lot about stop loss hunting and how to save yourself from it. So watch that as well. Consider that as a part of our course, and watch that as well. And in the next session, what should we do? Okay, what have we left in? We are left with option chain, we are left with open interest, we are left with risk management, position sizing, we are left with multi-time frame analysis. Okay, multi-time frame analysis is something that um, is not going to really help you in intraday because it is kind of for swing trades and investments. So we can omit that. Okay, so we will take risk management and position sizing for next session. Now this is where the real deal is starting. The real thing is of this course is starting. Risk management, position sizing, and then we have open interest and option chain analysis. So this is the part which you should be most focusing on. So we will do that in the next session, and make sure to have notebooks with you to jot down whatever you are learning, because you will otherwise you will forget what you learn in 2 days. So when you write down, you will remember what you had learned, and then it will be easier for you to apply it in markets. So I will see you in the next session. Until then, take care and bye bye.